You ever look at a company's stock and just think, this makes absolutely no sense? Well, that's exactly what is happening with Figma right now. Seriously. We've got investors looking at two completely different pictures, and it is creating this massive disconnect between the stock price and how the business is actually doing. So let's break it down.
Okay, so check this out. On one hand, the stock has been absolutely crushed. I mean, it's down almost 50% just this year. But then you look at the business itself, and it's on fire. Revenue is up an incredible 41% year over year. A stock that's plummeting next to a business that's booming, it's a paradox, and honestly, it's got Wall Street completely baffled.
So what gives? Is the market seeing some kind of fatal flaw that the big revenue numbers are hiding? Or is this one of the most misunderstood opportunities out there today? We're going to dig into both sides of the story.
All right, let's start with the bears. Let's try to get our heads around this massive sell-off. Why is Wall Street so down on a company that's so clearly growing like a weed?
Now this is where it gets really interesting. Context is everything, right? Figma isn't just down. It is getting hammered way worse than its rivals. The stock is down almost 50%, which is way worse than its main competitor, Adobe. And it makes the broader tech sector's little dip look like, I don't know, a rounding error. So this isn't just a market thing. Something specific is spooking Figma investors.
So what's behind all this negativity? Well, Wall Street's worries really boil down to 5 main things. First, you've got competition heating up from giants like Adobe and Microsoft. Second, there's a feeling that Figma's big push into AI has been kind of underwhelming and super expensive. Third, those AI costs are starting to squeeze their profit margins. Fourth, a lot of people think the stock was just way overvalued after its IPO. And finally, you've got the early investors who are now selling their shares, which just adds more downward pressure.
And this feeling isn't just on Wall Street. This quote from a Reddit user who's a designer that actually uses the product, it just captures the confusion perfectly. Even the people who love Figma and use it every single day are looking at this stock chart and wondering, wait, am I missing something? Is there some big hidden problem here that I just don't see?
But that is only one side of the coin. If you just ignore the stock ticker for a second and look purely at the company's performance, a totally different and, frankly, much sunnier picture starts to emerge. So let's flip over to the bull case.
The bull case starts with this number right here. Over $1 billion in revenue for fiscal year 2025. This isn't some small startup we're talking about. This is a software powerhouse. And it's growing at an incredible 41% year over year. I mean, that kind of growth at this scale is just super rare, and it tells you that their product is in crazy high demand.
So how are they doing it? Well, it's this awesome 3-step growth engine. First up, their customer retention is phenomenal, a 136% net dollar retention rate. All that means is that existing customers spend 36% more with Figma every single year. They don't just stay, they spend more and more. Then they're expanding into big companies like crazy, a 47% yearly jump in customers paying over $100,000. And on top of that, the platform is just incredibly sticky. Over 3/4 of their customers use more than one Figma product, which means it's getting baked right into their daily workflow.
And this chart, wow, it just perfectly shows their land and expand strategy at work. Look at where the money comes from. It's like the 80-20 rule on steroids. Just 2.5% of Figma's customers, just a tiny slice, are generating almost 2/3 of the company's entire revenue. This just proves how good they are at getting in the door with a small account and turning it into a massive, high-value partnership.
And the bulls are saying the growth story is far from over. I mean, look, there are 2 huge untapped opportunities right in front of them. First, international. 85% of their users are outside the US, but they only bring in about half the revenue. That's a massive gap they can close. And second, even though 95% of the Fortune 500 already use Figma, most of them are just scratching the surface. There's a giant opportunity to get them to spend a lot more. So this brings us to the heart of the conflict, right? How can 2 groups of really smart people look at the exact same company and come to completely different conclusions about what it's worth? Well, it all comes down to a tale of 2 different ways of valuing a company.
On one side, you have the analysts who use what's called a narrative model. It's heavily influenced by market sentiment, all those fears we just talked about. They land on a fair value that's actually below the current stock price, saying it's overvalued. But then, on the other side, you have analysts using a discounted cash flow, or DCF model. That one focuses purely on how much cash the business can make in the future. They come up with a much higher value, suggesting the stock is a bargain right now.
So what's the difference here? Think of it like this. The narrative model is all about the story. It's about the fears, the hype, the emotions that often drive tech stocks. The DCF model, though, is just about the math.
It's a cold calculation of how much cash the business is going to generate down the road. One is based on emotion, the other on calculation. And right now, they're leading to opposite conclusions.
Okay, so after all of this conflicting evidence, what's an investor supposed to do? What's the final takeaway? It really comes down to which story and which set of data you believe in more.
So let's just put it all out on the table, side by side. The bear case? It's all about outside threats like competition and inside challenges like AI costs and shrinking margins. It's a negative story. The bull case? It focuses on the undeniable strength of the business itself, a product that people love, incredible customer loyalty, revenue that's speeding up, huge growth potential, and a valuation that looks pretty cheap if you just focus on the cash.
Ultimately, it all boils down to this single question. What is the real story of Figma? Is the stock's big drop a giant red flag, a warning sign of deep problems that make this a classic value trap? Or is the market just so obsessed with the negative story that it's completely missing the incredible growth engine humming right under the hood, making this a deeply misunderstood opportunity? The answer to that question is going to decide everything for Figma stock.